This is Matthew Cratter from Trader University, and today I want to talk about whether the US dollar is going down. I've been getting a lot of questions about this. One way to take a look at this is to look at the DXY, the US dollar currency index, ticker DXY. We can see here that it's sharply lower since February of 2020, so it's really gone down over the past year. We had a brief period of dollar strength, which got all of the US dollar bulls very excited, but then there's been a huge amount of money printing. And what this shows is that the US dollar has been falling versus a basket of other currencies, mostly just the euro and the yen. When the chart moves up this way, it's the US dollar strengthening. When the chart moves down, it's the US dollar weakening against this basket of other fiat currencies. But the real point I want to make in this video is that all of these fiat currencies are sinking ships and that purchasing power is going down across all of these different currencies. And there's a really easy way to demonstrate this. Though you would never know that currencies are losing purchasing power, another way of saying the loss of purchasing power is inflation. If we look at the CPI, which is one of the most fraudulent indices ever created by a government, it shows that inflation is at roughly just above 1%, and it's been fairly low, as we can see here, for the past 4 years, really for the past 20 years, the way the government measures it. But what they do is they take a basket of things and they adjust it to make inflation seem much lower than it actually is. There used to be a very good inflation index that I often referenced called the Chapwood Index. For some reason, this has completely disappeared from the internet. And if you go back and look at my previous videos, if you Google CPI inflation, Trader University, you'll see I have some snapshots from Chapwood, and it showed that the real inflation rate, if you don't use all these bizarre adjustments that the U.S. government does, like the hedonic adjustment, etc., and if you don't have all these substitutionary effects in the index, that you actually are getting inflation anywhere from about 9 to 12% in all the major urban areas in the U.S. But we don't need to rely on anyone else's statistics, especially government statistics. We can just take a look at how prices have moved in various asset classes over the past year. So if we look at U.S. housing, United States home values, this is for the past year. We only have the December number, so we're looking at December 2019 through December 2020. 2020 was obviously a difficult year for many people, and there was lots of talks of deflationary collapses in various asset prices. But what we saw, in spite of everything, in spite of the huge job loss, in spite of the pandemic and all of the lockdowns, etc., that home values in the U.S. went up 8.4% over this period of December 2019 to December 2020. So basically, U.S. housing price inflation was 8%. Obviously, this isn't factored in the correct way into the CPI. We can look at individual markets just to get a quick sampling. Los Angeles home values, and this isn't even looking at the really expensive neighborhoods, but sort of an average of all of them, up 10% year over year. Seattle shows something similar. Seattle metro area up 9.8%. Denver up a little bit less. There's a little bit less scarcity in Denver. You have lots of wide open spaces, and you have the plains leading off from the front range. So these Denver home values only up 7%, but still a far cry from CPI inflation of 1%. Finally, Austin, which has really benefited from a huge outflow of people, especially from the Bay Area and from Silicon Valley and from California in general, up 14%. And so inflation is a very personal thing. If you want a house in Austin, if you want a house in Denver, Seattle, Los Angeles, your inflation rate, your personal inflation rate is much closer to 10%. If you want a house anywhere in the U.S., on average, your inflation rate is 8%. If you're finding this video helpful, I'd encourage you to hit that subscribe and like button. Let's look at some other hard assets, real things that, and see how their prices have changed over the past year. Here's a chart of copper, not bad for a global recession and pandemic. last year at about this time, we were trading up approximately, call it 260. Now we're up at 383, which is a very big move for copper. These are the copper futures I'm looking at. Something similar is true for silver. Silver, we're trading above where we were. We obviously sold off in a lot of these assets during the liquidity crisis of March 2020, but we're very far above where we were. Silver was approximately 15, 16 at this time last year, currently at 25 and probably heading higher. It's not quite as scarce as Bitcoin or gold. Let's look at gold next. Gold, a little bit disappointing performance, but still up significantly from a year ago. And so if you measure inflation rate in these various assets, they're obviously a lot more than 1% CPI inflation. Bitcoin, obviously up just a tremendous amount. The chart goes parabolic. At this time last year, we were trading at roughly, call it 10,000, and now encroaching on 50,000. So a 5x in Bitcoin. But even if you want to buy a basket of assets, let's say you want to buy the S&P 500, where that was trading a year ago was approximately, let's see, call it 337, 338, currently at 392. So whatever it is you want to purchase, if you wanted to buy Amazon, if you wanted to buy Tesla, if you wanted to buy Apple, all of these have become more expensive. Obviously, a basket of them, the QQQs, has become more expensive. And this gives the lie to what the CPI index says. And obviously, if you have expenses like medical expenses, these have gone up over the last year. If you pay tuition for your kids' schooling, or if you pay college tuition, those have all gone up over the past year. So we've had inflation in everything that you really want. Maybe pencils haven't gone up. They've gone up at 1% CPI inflation rate. But anything that you really want, housing, assets, precious metals, stocks, Bitcoin, anything that's scarce, anything that's necessary as well. You need to live in a house, either owning it or renting it, or an apartment. You need to buy stocks, for example, for a retirement account, etc. Anything that's scarce like this that can't be printed up by the Fed has appreciated remarkably. And so when people talk about, is the US dollar going down, I want you to think back what things cost 10 years ago or 20 years ago or 40 years ago, depending how old you are. And you know that real things like hamburgers and houses and stocks always go up in price. In other words, the fiat purchasing power goes down over time. And if you've been watching this channel for a while, you know why this is. We've got the Fed money printer at the Federal Reserve, which is the U.S. central bank, really massively increased the money supply over the past year, up, call it 26%. And you have all the other central banks, the ECB, the Bank of Japan, the BOJ, etc., all the different central banks increasing the money supply of their fiat currencies. And what this does is it pushes up prices. It pushes up asset prices, especially real estate, stocks, Bitcoin, things like this, and increases wealth inequality. This is one of the very unfair things about the fiat system and about central banks in general. And so when you hear that the US dollar may be falling, what really matters is whether it's falling versus real things, and whether whatever country you live in, whether you think in euro or yen or Canadian dollars or Australian dollars or whatever, the real question is that paper money losing purchasing power? Obviously, the US dollar is a very important currency because it's still the world reserve currency. And so what happens to it affects a lot of other fiat currencies. But the basic, if you're betting on currencies, if you're doing currency trading, basically these are all sinking ships. And if you want to be long one fiat currency against another and short another, you're trying to make a bet on which currency will sink the fastest. And what I'm most sure about is just that all of these currency boats will continue to sink. This is why asset prices are going up, simply because fiat currencies, especially the US dollar, are going down, and they'll continue to go down as the central banks continue to print. And so when you hear people say the stock market's in a bubble and the housing market's in a bubble and Bitcoin's in a bubble, I want you to remember that this is the sign of the failure of the current fiat system, especially the US dollar system as the world reserve currency. When you have fiat currencies losing purchasing power, it makes everything go up, everything that's denominated in those currencies. And the result is you get what a lot of people are calling the everything bubble. But is it really a bubble if the currency is going down and will continue to go down, not just against other currencies, but against real things, scarce things like real estate, like stocks, like Bitcoin? Fortunately, we have Bitcoin now. Bitcoin is the most honest thermometer in the room. And when we see what Bitcoin has done over the past year, this gives us a real insight into the real devaluation of the US dollar and of other fiat currencies. Because if you look at Bitcoin in terms of really any other asset price or any other fiat currency base, Bitcoin is going up in euro terms, it's going up in yen terms, it's going up in Australian dollar terms and Canadian dollar terms, and every other. If you look at some countries like Venezuela or Zimbabwe, obviously the Bitcoin's going up even faster in terms of those currencies. That's my take on the US dollar and other fiat currencies. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.